Hello, everyone, and welcome to another episode of the Loan Officer Experience Podcast. Today, we're going to be talking about protecting your book in the future of the mortgage game. And today, we've got someone who I've done business with for a very long time. Jay, you've been doing business for a long time with Sierra Pacific Mortgage Company. Man, you've always been one of my top go-to lenders. You really have been. Like we've loved working with you guys. Y'all have been fantastic for us. And I'm finally excited to bring you into this conversation on this podcast to talk about the industry with your vast knowledge and your charm and high levels, charm and sex, just to throw that out there. But today the conversation is going to be about helping loan officers get ahead. And the way we do that is protecting your book, right? And I want to talk a little bit about the three that are gearing up for this fall, knowing also want to discuss a little bit about knowing your referral partners, how we double down on which ones to maybe fire, which ones that we need to align ourselves with. Just get some insider information from you being on that, the side that you're on. So without further ado, let's welcome Jay Promisco with Sierra Pacific Mortgage Company. Welcome, Jay.
Hey, thanks for having me. That's number one. I love hearing the fact that people enjoy doing business with us. As you know, this business, it's a pretty small business. It's in some ways you end up working with the same people for the rest of your life in this business. And so hearing good things about your company is always a nice thing. You think you're doing everything right, but until you hear from somebody else, it definitely doesn't hit home. So thank you for having me.
Oh yeah, for sure. And I actually looked up my numbers and it was quite a few with y'all. I did a year to date last year even. And we had I think you were definitely on the top three of the lender partner with. And so I don't like working with people that I don't like, know, and trust. And you guys are definitely at the top of that list. So let's just jump in, man. So, what do you think, Jay, loan officers can do, brokers can do, preparing, for what's coming in our industry, as early as fall into the next couple of years, even?
Yeah. I mean, even if you look at today, I don't know when this thing will go live, but the market has been waiting for data to materialize that would tell us that rates need to come down. And over the last few weeks, we've started to see that type of data. It's been my view for quite some time that the economy is not as good as people are saying it is. And we're in this weird business, as you know, where it's not like we like rooting for unemployment. But when we have unemployment, generally speaking, rates come down. It's really good for mortgage bankers. And so this 10-year's been up and down and all over the place. And today we're down in the 407 mark. And we're starting to see rates start to push their way down. If you look a year ago, and we're selling 7.5%, and today we're selling 6.25%, 6 3/8, or whatever it is. And if the mortgage gods do their thing, we might be selling rates in the 5% range here in a few weeks. And so what's important more than anything is I think the industry has gotten a little bit stagnant over the last 3 years. Has been brutal. And doing a refinance is like this novel concept. And I think a lot of loan officers, a lot of brokers, a lot of companies have been in coast mode for quite some time. And maybe they've been focusing on their real estate partners and trying to do purchase business. But what they've forgotten about are all these people that have done these loans over the last 3 years. And the case in point is I think the industry is terrible about this where, hey man, I put this borrower in my CRM. They get an email from me once a month. They're going to come to me when it's time to go. Right. The problem with that is over the last 3 years, there's effectively been 4 lenders who have been buying north of 60 to 70% of the production that other wholesalers have been doing, retail lenders have been doing. And those 3 to 4 companies have been aggregating that production, getting ready for a fall that's going to come. And those companies that have been aggregating all of that servicing have been exceptionally good at putting together technology, call platforms and a million loan officers that are going to get paid nothing to do refinance over the next
Yep.
year or two.
Yep.
And their outreach, their marketing is really, really good. And so what you asked me, what should loan officers be doing right now? They should be getting really organized in their process, their procedure. Can I say this all the time? Like you look at a loan officer doing 4 or 5 loans a month or 6 loans a month, and over the course of 2 years, maybe they've done 120 loans, maybe. And I've asked my loan officers, well, do you call those 120 people once a month? And the answer is no,
Right.
100% of the time. And I'm like,
100%.
and you're telling me you don't have time doing 6 loans a month to call 120 people in a month just to remind them of who you are and what to do. And they rely upon technology and CRM and what and social media to drive all their business in, just assuming that their borrower is not going to cheat on them. And that what you'll see is when you look at data from the big three, the retention rate is in some cases 60 to 70%. That means 6 to 7 out of 10 borrowers that you've done with are going to cheat on you and go somewhere else. And that's scary. I mean, loan officers have put a lot of work into getting these purchases done, and they're going to miss out unless they're getting organized today.
Yeah, I love that. Now, listen, if you're listening to this, like, this is what I love about you, Jay. You're just a straight shooter, and you kind of struck a nerve even with me just hearing what you said. And you painted a picture of a reality that's going to come true 100% without question. And you basically asked everyone listening, are you ready? And so I want to just tap the brakes there. Okay. Because if you guys you don't know Jay, and I don't know Jay personally as well as I know people in this organization I've worked with for years or I've known, but I've gotten to know Jay a little bit, and this is kind of who he is what you're seeing. And so I want to tap the brakes on the knowledge you're dropping. I want to know a little bit about Jay, because guys, I'm a firm believer that when you get to know someone in this industry and you begin to know and trust them, you want to do business. At least I do, Jay. I want to do business with people that I like and that I trust are going to shoot me the right way. I don't always chase the lowest rate, because it's not about that for me, right? It's about, our competition's retail, right? My competition is brokers, And so even sometimes when I work with brokers who, regardless of who they are, I'm not looking at the best price in most cases. I'm looking at the relationship, okay, and who I can trust to handle my business. And it's important to me. And so I say all of that because it's just important to me. And it's important, I think, for you to share a little bit about your experience and background and who you are in this business.
Yeah, I'm a recovering loan officer. So I got in, right out of college, I got into financial services, and I worked for Morgan Stanley, Dean Witter. I was an options trader for E-Trade for a number of years. Moved over to Barclays Global Investors, worked into the derivatives front. And there was a day, long story, but my mother was the head of sales training at Headlands and Greenpoint Mortgage. And she'd been doing mortgage since I was a baby boy. And I was kind of tired of getting up at 4 and sitting on a trading desk. By the way, it was a phenomenal job. I loved doing that. But she said, you could come in the Greenpoint call center. You could do loans. You could make twice the amount of money and play more golf. And I was like, I kind of like that idea. And this was about 2003. And so I jumped over into the mortgage game, jumped into a call center, and ended up being one of the top loan officers on the board 2 months in, because I'd been selling other bigger things. And so I fell in love with the puzzle part of it, putting things together. And so I was a loan officer there for a number of years. I jumped in, I was a mortgage broker for a couple of years. And then I went, like many people, you go to the Stagecoach and you go work at Wells Fargo for a couple of years as a loan officer, and then you figure out why you don't want to work at Wells Fargo. And then you end up other places. So then I was a loan officer at Stearns. I ended up at Stearns for 10 years.
Wow.
Ended up running a branch, a region, a division. At one point, my CEO tapped me on the shoulder and said, "You need to come down to corporate." And the biggest mistake is taking your top salesperson and put them in corporate.
Yeah.
But then it gave me the format to be able to help not just one loan officer, 5 loan officers, but a couple hundred. And so over the course of the years, I've been running retail and gradually moved my way up, running kind of all channels. Today, I've got technology, operations, compliance, legal, capital markets, kind of all under my stead. And I think what makes it relevant is I've done the loan officer job. I've been a loan officer longer than I've been an executive, and I kind of know what not to do, because there was a time where I was a really, really bad loan officer. And so my job today is to help loan officers not make the mistakes that I did. Go down rabbit holes you shouldn't go down, chase referral partners you shouldn't chase, say yes when you should say no. Because I've made all the mistakes, and I can't tell everybody what to do, but I can tell you what not to do. That's what I'm really, really, really good at as far as that goes. So, but I love the game. It's just like this industry. If you're a loan officer, you don't need a college degree. You can make NFL money, and you don't have to get your head beat in every day. I mean, it's that special. And by the way, you're putting people in homes every day, and you're fixing things every day, and so it's incredibly rewarding. So that's my story.
Yeah, I totally agree, and I appreciate you sharing that. Now, you talked about, when we were talking about, what's happening and what loan officers need to really be focused on. One of the things you said was get organized, right? And when you say get organized, I'm assuming that, if we dive into that, it's dialing in your processes and your systems, but really, to me, it's a lot of point of sale automations, and it's going to be a lot of follow-up automations to your past database. Are there any other things that loan officers should be doing right now to protect their business? Is you got any other specifics that you want to add?
Yeah, there's probably 3 or 4 things. Number one, you got to get your house in order and your backyard cleaned up, and that means your desk. You start there, right? And so, what is your daily routine? Are you showing up at 10 o'clock in the morning, or are you showing up at 8, ready to go? You got your workout done, you got your family situated, and you're ready to go when it's go time. You need to have a disciplined approach here. What some of the mistakes loan officers make: hey, I closed 5 loans this week, I'm going to take Monday through Wednesday off and go play golf. Well, we all know what happens when you take a few days off in this industry. You're 2 weeks behind. So organization around what is your game plan on a daily basis and being consistent with it. Your database, which is like everything to you, is that organized in a way that's easily accessible? Do you have them segmented by, these are all every loan that you originated over the last 3 years is going to be in the money for a refinance here very shortly. Do you have those segmented in a way to where you're touching these people more often than people maybe that you did, 2020? The 2020 guys, look, maybe they'll refi, maybe they'll put cash out, maybe they will. But segmenting your book in a way that's easily accessible and marketing appropriately to the different segments of your book. I've seen a lot of loan officers, they take their whole book, no matter who it is, what state they live in, what interest rate, and they're sending them the same stuff. And it doesn't really drive any value, because you have to get really specific about your marketing to the segmented part of your book. If there was one piece of advice that I would give to a loan officer today, and I think it's said it, it's like, why are you not personally calling these people on a monthly basis? Maybe you have 5,000 loans that you funded. Okay. But if you segment it out, there's probably maybe 100 that might be in the money for a refinance. Why are you not calling these people on a regular basis, checking in with them? Right. And if you were organized and you knew about their family and their friends, and you took a good 1003, this customer outreach, to give you a sense of the hill we have to climb between, I'll just throw them out there. Rock and Cooper now own 1 out of 6 loans in America are serviced by those guys.
Yeah, it's crazy.
And not the number of phone calls and emails and things that they're doing right now. There's a reason they were buying loans from mortgage brokers and retail lenders, because they thought they could refinance it at some point in the future. And so that personal touch, super important. I think another thing that people are not thinking about, and brokers and loan officers get stubborn about this. A loan officer at one of these companies isn't working for 250 basis points. They're working probably for $100 a file. And so it's a good time now to look at your comp plan to see if it's appropriate or not. Because regardless of how good of a salesperson you are, if somebody's rate is 0.5% lower than yours because you're trying to pull off a 250 comp plan, you're going to get beat. All right. So reevaluating your compensation plan is definitely something I'd be looking at as well. Customer outreach, your comp plan, organization, and your discipline. Are you willing to put in the work to call these people and follow up? And oh, by the way, they may tell you no, but are you asking for referrals from them? Right. And people forget that part too. So staying in front of this book, and it's got to be the trifecta. You've got to be using your CRM and emailing them. You've got to be calling them. You might want to think about mail. People love mail. People don't get mail so much anymore. Mail works as well.
Yep.
And then having these profiles on every customer you have and making sure you're following up with them consistently. And a lot of loan officers too, they'll take a loan application, they'll get it to processor, and they'll forget about it. And it just blows me away, all the other touch points you can have during the loan process to make sure they stay with you, right?
Yeah.
Especially if you see interest rates continue to come down, they're going to go shop you. Well, you got to keep them from shopping you by staying in front of them. So
yeah, that's good stuff. I will say this, something that I've done and it's worked really well for me. And I've done it one day a week for the last 3 weeks. Man, I literally this is what I do. I grab my phone. I just shoot a quick video. It's like a 25 to 30 second video. And I'm telling, that video is going to my refinance database. So I've gone in and I've done exactly what you said. I've segmented, my FHA, my VA, and my conventional loans, right? Separate. And I've gone in there and pulled out the ones that could benefit from a refinance now, right? Mm-hmm. And I say in the video, it's just a quick video. Hey guys, and I'm not emailing it to them. I'm texting it to them.
Yes.
Because the video, right?
Yeah.
And in the video, I'd say, hey, all you have to do, you don't have to call me back. Just email me, text me your mortgage statement, most current mortgage statement. All I need, right? And he goes to the team, and it's just and I'm not kidding you, Jay. I've gotten probably, I'd say 10 to 12 mortgage statements, and the team jumps on them. We get them, we run through them as quickly as we can. And every time that we've done a video, we've probably gotten 4 or 5 refinances. That's crazy. So you compound that weekly and you do it consistently. And you know what? I don't have the best system in that regard, right? But I have my database. I know who's in my database. I know who would benefit from a refinance. And as these rates drop, that list is going to grow. And it's we're already coming up with ways to streamline it so we don't have to, to wait, And so I love that you said that, because that's, and for you guys that are listening, it's that simple. It's not a hard thing to do. It's just making time to do it. And then you brought up the comp plan the way you did, because I feel the same way, man. It's I would rather have a half of a watermelon than 100% of a grape.
Mm-hmm.
Think about your refinances, man. You really have got to think especially on your VA loans, right? The VA loans, the streamlines for those are so simple. It's can your comp plan be less for that? Or your loan officer is willing to win more deals if it's a lower comp plan. That's something that you definitely need to think about. Or if your loan officer working for someone that, hey, do I need to lower this to be more competitive in the marketplace? Definitely something to consider. Well, let's talk about referral partners. You did mention them a moment ago. You and I both know that the wrong referral partner can drain time and energy from a loan officer. So why do you think so many LOs hang on to them anyway?
Desperation. Maybe it's a friendship that you don't want to break up with.
Yeah.
The best thing, I'll tell one quick story. When I was a loan officer, this is in and this is a bad time too. It's like 2007 and 8, if you guys remember that. And I had
Right. Yeah.
this one real estate agent, and all we were doing was doing investment properties. And he was the biggest unpleasant person to be around. And granted, I was doing 6 or 7 deals a month with the guy, but I had one day, and but by the way, sucking the life out of you and keeping you up at night and taking you away from your family and calling you at freaking midnight and all the different things, right? And I finally woke up one day. I said, I'm not doing it anymore. This guy's name was Bill. I was like, Bill, it's not happening. You go find somebody else to work with. And this magic thing happened. All of a sudden, all this time opened up for me. I was able to focus on other agents that were a little bit more friendly to be around, and my business doubled because I wasn't drowning with this one person sucking the life out of me. And now, and this is back then when we didn't have data, because all the real estate agents then said, "Oh yeah, I'm closing 12 a month," and there was no way to prove they weren't. Now the data is there. I can figure out everybody who's selling a home and everybody who's not. And then the second part of that is there are real estate agents that will take you down rabbit holes you do not want to go down. So maybe they're specializing in, choose my words carefully here, loans that will take up your entire day because it's their only deal they have, right? So maybe they don't have a lot of deals going on and they have the one deal they're holding on to, and you're working on a state bond program with a rapid rescore, with a second trust deed and a down payment assistance program. And I'm putting the cousin on a loan.
Mobile home. Yeah. Mobile home built on the water. Yeah, I got you.
Yeah. And now, like, for what? And why are you doing that? Right. So like, if I said no to that, I'd probably say yes to 5 other things I could be doing. And so choosing your referral partners, the data's out there. It's easy to find out who's selling homes, who's not. If they're not selling homes, don't call them. That's not even worth a coffee. Like everybody's like, take a guy out for coffee. It's not worth the coffee. The price of the coffee is not worth talking to this person because they're not going to do nothing but drag you down places you don't want to go down. And by the way, the good referral partners, it's going to take a while to earn their trust. So that's the long game here, right? So it's not going to happen overnight. But at some point, they're probably working with a loan officer and that company is going to fail and they're going to miss a closing. And hopefully you show up on that day that they're having a bad day. They're willing to take you on. This is hard for a loan officer, and I did it, and I paid for it. I did not want to release these people. I wanted them to keep using me, but the minute I let go, it brought me to different referral partners that were going to be better for me long term. So
100%. I couldn't agree more. You kind of, you learn that through experience, and, I learned it as well. Sometimes, it's unfortunately the hard way. I think that a lot of loan officers, this is what they do. They take ownership of things that are beyond their control sometimes, or they take on a file that's going to be a reputation killer. Yeah. And they're fearful of saying no out of somehow that's going to be a reflection on them. Right. And then, they're working on this very hard file that you described, and then they are afraid to give bad news. And the longer you wait to get bad news, the more credibility that you lose. Yep. And it's all in everything and framing and managing the risk, being careful about what you take on and what you say no to. But I would say this, don't ever feel like you don't allow the circumstantial things to define or have a feeling about it that it's somehow a bad reflection on you. As long as you communicate that and you're bold with it, I think realtor partners especially respect that more, than they do letting them beat up on the loan officer. I used to let these realtors beat up on me, man. They know better now. They really. No, I ain't messing with the KT because I'm going to be on the right side of it. Anyway, I just think that's very important.
The one secret to my success, and I learned this from a sales trainer a long time ago. This is even before mortgage. When somebody comes in and they apply with you, the answer should never be, "Oh, this is easy, slam dunk. This is going to be no problem at all." That's the worst thing you could say. Mm-hmm. And if you go into your real estate partner, like, "Can you do this deal?" You're like, "Yeah, man, it's going to be hard." right? This is not going to be an easy thing. I just want to prepare you. But I think we can get it done, but it's going to take some work, right? If you set that expectation up front, when you finally have obstacles, by the way, every file we do has an obstacle. You can be 760 FICO, W-2 wage earner, all the assets in the world, and the loan's still going to be hard. So setting that expectation up front, regardless of how easy you think the transaction is going to be, will help you too. So,
yeah, absolutely. Well, man, let's move on to something else I was wanting to ask you. And I know that you've got some experience around the AI, the AI industry, so to speak. Me too, right? So this is something that's the last year very involved with. So I'm excited to hear what you have to say about it. But so you're involved with AI firms. You have a lot of data and information on capital markets. You're very close with agencies, and I just want to get some feedback from you in terms of even MBS, even the markets, right? So what feedback can you give us regarding, the market, MBS market? What do you think's happening? What's going to be driving it moving forward? How does AI transform maybe some of the back end things that we're traditionally, have to manage, whether it's on the broker side or a mini correspondent lender with audits, QC, fraud, all the things that we have to do. How's things going to be changing in that world, let's say over the next 6 months or so?
yeah. The one big material shift that I've seen just in the last probably 6 to 8 months is the agencies themselves have deployed technology to where any mistake on a loan is found out. And you go back, historically, you would put together a pool of loans, sell them to Fannie. Maybe 1 out of 5, 1 out of 10 loans gets audited, right? And then maybe the lender has a problem. Well, that percentage has now gone up to 100%. So they're going to find everything, which now lenders like me, we're deploying technology so that we can find that out at the point of sale. So I can figure out everything that could possibly go wrong with that loan the minute that submission comes in, because the number of lenders like me and all my peers, the number of repurchase requests, indemnifications, problem loans, scratch and it's gone up considerably. Why? Because the agencies have gotten really good at snorkeling out bad loans. And it could be, miscalculating the income. It could be a collateral issue with the tile on the roof. It could be a number of different things, but 100% of the collateral now, appraisal wise, is going through an AI engine at the agencies, figuring out if it's good collateral, bad collateral. So there's no hiding anything anymore. And so back to being a good loan officer, talking to a borrower, tell me everything now, because at some point in the next 30 days, we're going to figure it out anyways. So AI is good and bad. AI can help you streamline your process and help your manufacturing costs and those types of things, but just know the agencies on the other end are using it too. And what you'll find is guidelines are going to be held to at different lenders. There's no magic exception anymore, right? Can I get an exception on this? No, it doesn't work because the agencies aren't going to buy it. And so it's that simple. And most of the aggregators that are, maybe you're selling flow like we are to Fannie Freddie, but maybe people are selling the Freedom or New Res or PennyMac or whatever. They're going to find that stuff out too. So loan quality has become probably the single most, for a lender my size that we're focused on the most, is loan quality. That is this borrower qualified? Yes or no? Do I have all the appropriate documentation to file? Yes or no? When I sell this loan, will it stay sold? Now, from an AI perspective, AI is a funny word for me because there's a lot of people are saying they're using AI, and what they're really doing is they're taking a file in and they have an offshore team working on it. Right? That's a version of AI. DU and LP is a version of AI, right? So, I think brokers and loan officers might be going down some different paths. There might be 2 guys in a garage that develop this AI platform that's going to help them, and you're going to spend a bunch of money deploying the technology. It's not going to help you. It costs you money, and maybe the guys last a year, maybe they don't. But there are some things you can automate from a marketing perspective using ChatGPT or Gronk or one of the other, those types of things. I think from a marketing perspective, generative AI is exceptional for you. It used to take us 2 weeks to do a flyer. Now you can kind of do it in about 35 seconds, and it's probably going to look better anyways. But what most of the bigger companies are focused on today, AI wise, is creating elasticity in their fulfillment models, as in using agentic AI so that a processor underwriter can underwrite more than 2 files a day. Maybe they can do 5 or 6 or 7, right? Why? Why is that good? Because the worst part about this business is as soon as we get busy, all of a sudden I've got to hire 500 people. And then we get slow, and I got to lay off 400 people, and then vice versa. And so the industry is kind of tired of that. And so if I can create a fulfillment model where I can do, 1,000 loans with this amount of people, I can do 2,000 with this amount of people, that would be a good thing, right? So keeping the headcount steady. So as far as the MBS market goes, the MBS market is waiting for rates to come down. That's really what it is, right? So there isn't a lot of trading. Most of the servicing books have changed. A lot of servicing has been sold over the last couple of years from legacy owners or bigger companies trying to raise capital. Because by the way, the last 3 years nobody's made any money, and that's a cash bleed. So a lot of people selling servicing to generate cash flow to keep their businesses afloat. That creates some volatility as far as MSR value. But again, if these rates stay down the way they are, if they go down even further, there will be a big appetite for MBS going forward. So it's still a safe haven asset, from especially the collateral we do today. And I don't know how down the weeds you want me to get, but there are certain geographies that will be more valuable than others in regards to MBS. There are certain markets in the country, good and bad, where sales prices are starting to decline. Just if you think about an example where I did a FHA loan in a market, it's 96.5% LTV, and if the sales price went down 6%, now that loan's underwater. So, borrowers underwater and those types of things. But in geos where the sales price is steady or improving, that MSR value will be worth more money over time. So.
Yeah, I couldn't agree more. It's so good. But I got another question for you. You ready?
Yeah.
Has anyone ever told you that you look like Stone Cold Steve Austin? No, never. Come on. Someone's told you that before. So if you guys don't know, I can see his face right now. That's who I was thinking. It looks like somebody I know, and
Not once.
Right, but not once. Oh man, come on.
I've gotten the only one I've ever gotten is Henry Rollins. So I've gotten Henry Rollins before. So no beard, Henry Rollins. So
yeah. Well, that really wasn't my final question for you. I did have one more. I just thought that would be a great one to lead with. So as we wrap up here, man, I wish I had more time to talk to you. I really do. I just love the path you're going with the data and information you're sharing. But if you had to leave loan officers with one piece of advice, okay, for this fall especially, what would that be?
One piece of advice. So I'd say take a day this week. That's all right. Take a day of the week and look at your desk, and is it organized? And then look at your schedule with your kids and your family, right? And decide what's important to you, right? Because by the way, it's been a long 2.5, 3 years, right? Yeah. What are you willing to give up to make sure that if these interest rates drop, you can take advantage of the market? That'd be my one piece of advice. And get your house in order, right? And maybe you have the conversation with your wife, like, hey, I might be working some 10, 12-hour days, or your spouse. Because here's what I know. If it's not right at home, it's not going to be right at work, ever, right? And you're going to miss opportunities in your mind. You're going to forget to call somebody back. It's like loan officer fail that I've done a million times. I forgot to call the guy back. Wait 2 days. I finally call him back. It's like, I don't know. Rocket called me. I'm working with him now. Right. And then again, we talked about at the beginning, 2 pieces of advice: get your house in order and get your book in order. Right. And look at your book, every loan that you've ever closed in your entire life, and segment it out. Maybe it's a yellow pad of paper. Maybe it's Excel. Maybe you have a CRM, but make sure it's organized. Make sure it's accessible, right? And then you have to decide how much work do you want to put in here. And the other just finish up with this. I hear a lot of nonsense about work-life balance, right?
Yep.
And I've been a loan officer a long time. I don't know what that means, right? It's either feast or famine.
Yeah.
And yeah, maybe you get to play more golf, but you're also going to miss out on some opportunities there. So you decide how much work you want to put in to be successful. So.
Yeah, I always say that we go through seasons of life, and sometimes the season is, you're grinding and you're in after it for those longer days, and then there's be seasons where you're a little bit more, work-life balanced, and some there's be seasons where you're struggling, and I think that we've the whole industry's seen that. Even top producers have lost their confidence in some regard, with previous history. Well, Jay, I certainly appreciate your time and your insight today, guys. For those that are listening. One of the things I wanted to share about Sierra Pacific Mortgage Company is they have dedicated and invested in you. So we have Fuse coming up in October 23rd, 24th, and 25th. You guys have sponsored the VIP brunch. You have a special speaker coming in, someone that I know very well, Damon West. And if you guys have not got plugged into to AIM, I would certainly encourage you to be able to do that. You guys will be promoting or be hosting that event for us at Fuse, and we certainly appreciate it. But if you haven't got your ticket for Fuse, certainly go to aimgroup.com. That's aimgroup.com. And you can buy tickets, Jay, are $4.99, right? To go to Fuse, but they get a membership for $199 that includes a Fuse ticket. So I'm just asking, what would you do? I mean,
probably, let's see, I'm just doing some math here. Probably the second thing you mentioned. Yep.
Yeah, the $199. It's kind of a no-brainer. So, save your money, become a member. You can do that through aimgroup.com. And again, Jay, we appreciate your time. Guys, until next time, we'll see you. And until then, make it a great day.